Contrarian thinking, the art of moving against the crowd. Sir John Marks Templeton did not become a legendary investor by following conventional wisdom. He rose to the top by doing what most people were too afraid, too emotional, or too uncertain to do. Think independently when the world moved in panic. Templeton believed that true investment mastery begins with the courage to challenge the crowd and the discipline to stay rational when everyone else is losing their minds. Templeton's most iconic principle was simple yet powerful. To achieve superior performance, you must adopt a superior approach. And a superior approach, in his view, meant walking a lonely road. It meant questioning assumptions, doubting popular narratives, and refusing to let collective fear or euphoria dictate decisions. History is filled with dramatic moments when investors were crushed because they followed the masses, bubbles, crashes, manias, and irrational plunges. Templeton watched these moments closely, not with fear, but with curiosity. Whenever the market became chaotic, he felt a strange calm. Where others saw danger, he saw a hidden map of opportunities waiting for someone brave enough to explore them. This mindset wasn't born from theory, it was forged through real crises. Templeton lived through the Great Depression, 2 world wars, countless recessions, rising empires, and collapsing currencies. He witnessed entire markets fall apart overnight, then slowly rebuild themselves stronger than before. These experiences convinced him that the crowd is often wrong at the most critical moments. When people react emotionally, prices detach from reality, creating windows where only independent thinkers can thrive. His contrarian philosophy wasn't just about buying low and selling high, it was about understanding human psychology. Templeton believed that markets were ultimately reflections of human behavior, and human behavior was deeply flawed. Greed, fear, impatience, overconfidence. These traits shaped market cycles far more than economic fundamentals. So Templeton trained himself to remain calm amid storms. He would deliberately step back when markets surged uncontrollably and lean forward when despair dominated the headlines. This discipline allowed him to spot opportunities long before the crowd realized what was happening. Contrarian thinking for Templeton was not a reckless gamble, it was a strategic edge. It required research, patience, humility, and an unshakable belief in rational decision-making. His success came from mastering these inner battles, proving that the greatest profits belong to those who remain level-headed when everyone else runs in circles. Buying in times of despair, opportunity hidden in crisis. One of Sir John Templeton's most enduring principles can be summarized in a single sentence: the time of maximum pessimism is the best time to buy. This was not just a clever quote, it was a philosophy Templeton lived by, tested through some of the darkest economic moments of the 20th century. To him, despair wasn't a warning sign, it was a beacon pointing toward undiscovered value. Templeton understood something most investors never fully grasp. During crises, prices stop reflecting reality. Fear becomes the dominant currency. Rumors replace research, headlines overshadow fundamentals, and in that storm of panic, good companies are often sold at prices so low they almost seem unreal. To Templeton, this emotional mispricing was the single greatest source of opportunity in all of finance. His legendary purchase during World War II remains one of the most dramatic examples. While newspapers screamed about global collapse and investors dumped stocks to protect what little they had left, Templeton calmly took out a $10,000 loan, an unimaginable risk at the time, and bought 100 shares each of over 100 companies trading at extremely depressed prices. Many of them were on the brink of bankruptcy, and some had already filed for it. His friends thought he had lost his mind. Brokers warned him he was throwing money into a fire. But Templeton wasn't gambling. He was calculating. He believed that even amidst war, not every company would fail, and the rebound from despair would be explosive. He was right. When the war ended and optimism returned, most of the companies he bought multiplied in value. That single contrarian move became the early foundation of his investment empire. Templeton's lesson was clear. Crisis reveals value, but only to those willing to look beyond fear. Most investors do the opposite. They rush to sell at the worst possible moment, driven by panic rather than logic. Templeton trained himself to stay calm, to examine numbers while others reacted to noise, and to trust long-term value instead of short-term emotions. He often said that buying in despair required two things: emotional courage, the strength to act when the world says you're wrong. Deep analysis, because not all cheap stocks are bargains, only those with real underlying value will survive the storm. Crises will always come: recessions, geopolitical shocks, market crashes, global uncertainty. Templeton believed that these moments were not threats, but invitations. They were the rare periods when the market offered extraordinary opportunities to those who understood that fear fades, value remains, and optimism eventually returns. To buy in despair was not a reckless act. It was a disciplined, calculated strategy that turned Templeton into one of the greatest investors of all time. Selling in times of euphoria, the art of exiting before the fall. If buying during despair was Sir John Templeton's trademark entry strategy, then selling during euphoria was his masterful exit. He believed that the peak of optimism is the most dangerous moment in markets, a moment when prices soar far beyond reason and investors lose themselves in fantasies of easy wealth. To Templeton, these moments weren't celebrations, they were alarms ringing loudly across the financial world. Templeton understood a fundamental truth: bubbles are born from emotion, not economics. Euphoria blinds people. They stop asking critical questions, stop analyzing real value, and begin to believe in stories rather than reality. When markets rise too quickly, they create an illusion of safety, as if the laws of history and economic cycles have suddenly vanished. Templeton often quoted one of his most famous warnings: "The four most expensive words in investing are, 'This time it's different.'" He saw those words appear before every major bubble: the roaring 1920s, the post-war boom, the Japanese asset bubble of the 1980s, the dot-com mania of the 1990s. They all shared the same dangerous belief that old rules no longer applied. But to Templeton, the cycle was always the same: irrational confidence leads to collapse. In such moments, Templeton would quietly do something very few investors had the discipline to do. He sold. Not because he knew the exact top, but because he recognized when prices had become detached from value. When neighbors, taxi drivers, and even people with no financial knowledge began boasting about guaranteed profits, Templeton knew the market had slipped into collective hallucination. He loved to tell stories of times he witnessed the madness firsthand. In the late 1990s, he noticed young investors rushing into tech stocks with no earnings, no history, and no clear business models. Yet they spoke about these companies as if they were treasures guaranteed to make them rich. The more enthusiasm grew, the more cautious Templeton became. And when he saw analysts projecting infinite growth, he shook his head and exited the market long before the bubble burst. His approach was not driven by fear, it was driven by discipline. Selling during euphoria required resisting the powerful temptation to stay in the game just a little longer, to squeeze out a few more gains. But Templeton believed that the final phase of a bubble offers the highest risk and the lowest reward. He taught that a successful investor must recognize emotional excess, trust valuation over hype, and accept that leaving too early is better than leaving too late. Templeton knew that fortunes are not only made by buying well, they are preserved by selling wisely. For him, the true art of investing was not predicting the top, but stepping away when the world was too blinded by optimism to see the fall approaching. Global investing, expanding beyond borders to unlock hidden opportunities. Sir John Templeton was not just an investor, he was a pioneer who shattered the boundaries of traditional finance. At a time when most American investors kept their money strictly within U.S. markets, Templeton looked at the world and saw something radically different: a vast, unexplored landscape of opportunity scattered across continents, cultures, and emerging economies. He often said, "If you only invest in one country, you miss 95% of the world's opportunities." This belief transformed not only his career, but the entire industry of global investment. Templeton understood early on that economies move in cycles, and not all nations rise or fall at the same time. While some countries are facing recession, others are growing rapidly. While certain sectors stagnate in one region, they flourish in another. Instead of fearing this complexity, Templeton embraced it. He viewed the world like a giant mosaic of possibilities, waiting for someone bold enough to connect the pieces. His global approach was not just theoretical, it was daring and often dramatic. Templeton traveled extensively, visiting countries many investors considered too risky or too unfamiliar. He met local business owners, studied new industries, analyzed regional politics, and observed cultural trends. Where others saw uncertainty, he saw undervalued markets filled with potential. One of the most striking examples was his early investment in Japan in the 1950s. At the time, Japan was still recovering from World War II. Factories were destroyed, the economy was unstable, and most Western investors would not even consider stepping foot into the Japanese market. But Templeton looked beyond the rubble. He saw a nation rebuilding with extraordinary determination, innovation, and discipline. Despite the skepticism of peers, he poured capital into Japanese companies when their stocks were unbelievably cheap. Over the following decades, those same companies would rise to become global powerhouses: Toyota, Sony, Honda, Nissan. Templeton's bold global perspective allowed him to profit from one of the greatest economic transformations of the 20th century. He repeated this pattern in Europe, South America, and even emerging markets long before the term emerging markets became popular. To Templeton, geographic distance was never a barrier. The only true barrier was narrow thinking. But global investing wasn't just about chasing growth, it was also about reducing risk. Templeton believed that diversifying across countries protected investors from local shocks. A crisis in one region could be balanced by growth in another. International diversification, in his view, wasn't optional, it was essential for long-term stability. Templeton's global strategy required courage, intellectual curiosity, and a willingness to challenge national bias. His success proved that the world rewards those willing to discover its hidden corners. Today, global investing is a standard practice, but it began with visionaries like Templeton, people who dared to look beyond borders and found treasures where no one else thought to look. Discipline, humility, and long-term optimism, the invisible foundations of greatness. While many investors obsess over formulas, technical indicators, or predictions, Sir John Templeton believed that the true pillars of extraordinary success were far more internal: discipline, humility, and long-term optimism. These qualities shaped every decision he made, and they formed the invisible architecture behind his legendary career. Templeton understood early on that markets do not reward the impulsive. He often warned, investing without discipline is simply gambling. To him, discipline meant having a clear strategy and the emotional strength to stick to it, even when storms raged across the financial world. It meant resisting the temptation to chase hot trends, avoiding fear-driven decisions, and maintaining a sharp focus on long-term value instead of short-term noise. This discipline was tested repeatedly throughout his life. Templeton lived through global wars, violent crashes, and economic panics that sent entire markets spiraling into chaos. He watched investors crumble under pressure, selling their best assets at the worst moments simply because the world around them was screaming in fear. But Templeton remained steady. His calm was almost unnatural, an anchor that grounded him when others drifted into emotional chaos. However, discipline alone was not enough. Templeton believed deeply in the power of humility. He warned that the greatest danger in investing was not ignorance, but overconfidence. He loved to remind younger investors, the investor who thinks he knows everything learns the most expensive lessons. Humility, for Templeton, meant acknowledging uncertainty, respecting market cycles, and accepting that no one, not even the smartest analyst, can predict the future perfectly. It meant continuously learning, questioning assumptions, and being willing to admit mistakes quickly. He viewed every misstep as tuition paid to the markets, valuable lessons that shaped sharper judgment. This combination of discipline and humility allowed Templeton to stay grounded in reality. But what truly set him apart was his unshakable long-term optimism. Templeton believed that despite wars, recessions, political upheavals, and technological disruptions, humanity consistently moved forward. He saw evidence everywhere: rising life expectancy, scientific breakthroughs, expanding global trade, and the unstoppable spread of innovation. Temporary crises, in his view, were mere interruptions in a much larger upward journey of human progress. This mindset gave him extraordinary patience. When markets fell, he didn't panic, he waited. When fear dominated headlines, he smiled knowingly, aware that recovery was inevitable. Long-term optimism enabled him to hold on to great investments long enough for them to realize their true potential. To Templeton, optimism wasn't blind hope. It was a strategic advantage. It allowed him to act boldly when others were paralyzed, to search for value where others saw disaster, and to remain confident in the fundamental resilience of the global economy. In the end, Templeton's teachings revealed a profound truth. Great investors are not defined by their intelligence, but by their character. Discipline keeps them steady, humility keeps them learning, and optimism keeps them fearless. Together, these qualities form the core of Templeton's greatness, and they continue to guide every investor seeking long-term success.